Hi guys, my name is Bashir and this is another video that I need to explain to you what are the key terminologies and to understand in the Forex market. So by my screen here, the key terminologies, the first terminology on the list is the PEEP. Now, the PEEP is the smallest unit change in price of a commodity, of an asset, or Forex, or Bitcoins, or coins, or ETFs, or indices, or whatever. So it goes by 1 divided by 100 multiplied by 0.01, which is going to give you 0.0001. So if a price is moving upward or downward, this is the change. It goes by this change as 0.0001. So the next thing you need to know is what is the difference of the bid price and the ask price, right? The difference between the bid price and the ask price is the spread, okay? By what I explained previously, the PEEP, you can call it spread in case, but the spread is simply the difference between the ask price and the bid price. And also, you can call it 2 pips or 3 pips or 4 pips or whatever. The first one I did is 0.001, so this is 1 pip, okay? This means 1 pip, right? So now, what is the base currency and the quote currency? When you have pounds versus USD, so on my screen here, you can see that GBP slash USD, that's Great Britain pounds by United States dollar. So this is the bid price and this is the ask price. So the difference is going to give you 2 pip. So when you minus 1.309 from 1.3089, it's going to give you 2 pip by your calculation. So that is just the difference between the base currency or the quote currency. You can say euro over United States dollar. So this is the base, this is the quote currency. You understand? So the next thing you need to understand is the lot. So what is a lot? So the lot is the volume, right? It's the volume of what you want to like buy or purchase or sell. It always comes when you want to buy, because you're coming to the market to buy something which you're going to sell later. So you can see from my screen, you have different lot size, different units, the volume and the PEEP. So the standard lot is 100,000 and the volume is 1.00. So mostly traders go for this lot. They go for this lot, that's 0.001. So with this lot, that means that 0.01, you can have access to about 1,000 units of any currency or of any Forex or of any instrument that you want to trade. So with 0.001, sorry, you can have up to 1,000 of that. You understand? So if you're going for 0.10 lots, you can have up to 10,000 units of what you want to buy. So that's the meaning of the lots. I'm going to show you an example maybe in the 2-3 videos when I'm going to post. So the next thing you need to understand is a leverage. So what's a leverage? So when you have a broker, right, the broker is the agent that is giving you money to trade in the market. So they're giving you money to trade in the market. If you have, maybe you made a deposit of $10, okay, and you want to trade up to like $100 in the market. So the broker can tell you that, okay, you have a leverage of about 1 to 100. This means that for every $100, they are giving you extra $100 for you to trade. So this means that you can leverage on a bigger size or a bigger position of assets or of security that you want to trade in the market. So you don't need to worry that, okay, I have $10. What do I do with $10? Can I make $10? Yeah, you can make $10 to become $100 if you're in a good position. But the broker is going to leverage. That means they're going to give you that money for you to be able to access up to 10,000 worth of security that you want to buy, provided you're not making loss, or you're making loss but making like higher gains. You understand? So that's what the meaning of leverage is. This is in the form of broker. The broker have them in their applications or in their website that they can give you to you like a loan or like a borrowing without any charge or whatever. So that's basically what the leverage means. So the next thing you need to understand is a margin. What is a margin? A margin is a required amount that you need to have in your account, trading account. You need to have this particular amount of margin for you to be able to make a position of a larger size, or any size rather. So if your required margin, it depends on the broker. The broker can tell you that required margin is $5. Okay, if your required margin is $5, that means you can trade with that $5. Okay, but if your required margin is $100, that means you need to have a deposit of up to $100 before you can trade a position of this size. That's basically what the margin is. And there's something called margin call. What is a margin call? If you have a deposit of $5 in your account and the percentage of your margin is dropping, that means your $5 is dropping to like $3 or $2 or $1, the margin call comes in. The margin call is like, oh, it's like an alert that will tell you like your position is going to like be closed because you're having a lower amount in your margin. So the required margin, when it gets low, you have a margin call. That's what the margin call means. So this is what margin simply means. The next thing you need to understand is the currency pairs. In Forex, you need to understand what the currency pairs. When you see something like this, look at my screen. You have USD, CAD. What does it mean? It means United States dollar and the Canadian dollar. That's what it means. You have Euro and Great Britain pounds. What does it mean? It means the euro and pounds. The euro and the pounds are almost alike. So you understand? So that's what the Forex is like, the currency pairs in Forex. So it's like currency pairs. You're pairing this currency with the other currency. You're pairing the Swiss francs with euro. You're pairing Mexican pesos with United States dollar. You're pairing different type of currencies together. So from this screen now, you can see from this screen that you have 44, yeah, right? You have 44. Sorry, you have 47, yeah. You have 47, you have 65, you have 134, you have 54, you have 3849, you have 47. So all these 47, 65, 134, 54, 3489, 47. Yeah, the difference between the ask price and the selling price. Okay, the ask price and the bid price. You understand? So the bid is the amount that the buyer is willing to buy, and the sell price or the ask price is the amount that the seller is willing to sell. So that's just the difference. So the next thing, yeah, I'm coming to that now, the bid and ask price. So the bid price is the price at which the buyer is willing to, have a product or have a commodity you want to buy. This is the price. I can tell you that, okay, the price is 400. Okay, you're willing to buy. If you're not willing to buy, ask someone else to buy. So the ask price, the price that the seller is willing to sell. That's the difference between the bid and the ask. Take note. So the difference between these two is called the spread. And remember, we explained what the PEEP means, right? That means 1 over 100 multiplied by 0.1, which is 0.0001. Okay, that is 1 PEEP. So the difference between the bid price and the ask price is called the spread. And the spread is what I explained previously in this, that 47, 65, 134. This is just basically the difference between the spread of the ask price and the bid price of United States dollar and the Canadian dollar, or the euro with the Great Britain pounds. Don't forget, please take notes. So the next thing you need to understand is the long position and the short position. What is the long position? The long position means that in a market, when you have a market that's going somewhere like this, you're taking a position that, okay, when I take a position, like when I buy from here, I'm anticipating or hoping that the market is going to go up, right? You're making that prediction that, okay, the movement is going to go up. You're taking a long position. That's the meaning. Okay, when you're taking a short position, is the opposite of the long. So when you have a market, right, moving different ways, you're taking a position that the price is going to fall. Okay, so this means short position, this means long position. Short position, you're taking a position that price is going to fall, so you're going to sell now, or you buy now, either of the two. Or you're taking a position that the price is going to go up, so what do? Are you going to buy or you're going to sell? If the price is going to go up, that means you're going to buy. You buy now because the price is going to go up. But if the price is going to fall down, that means you're going to sell because you don't want to lose a lot of money. That's the difference between the long position and the short position. So the next thing to understand is the fundamental analysis. What are the fundamental analysis? These are analyses that covers the fundamental or the basis of the market, which are the company analysis, industry analysis, macro analysis, and the profit future outlook of a particular company or a particular asset or whatever. So these conditions or these analyses are carried out by different experts, you understand? So they do use this analysis to ensure that, okay, the price of different securities in the market are well accurate, right? So that everybody can see that, okay, for the past 10 years, this is what has been happening according to the company, or this is what has been happening according to the industry, or this is the future profit outlook, or the future loss outlook, or the balance position of stock or stocks or bitcoins or currency or ETFs or bonds or whatever. You understand? So what again do you need to understand? You need to understand the technical analysis. Now the technical analysis, this is where you understand the chart patterns, you understand the moving average, convergence and divergence, you understand the RSI, that's the relative strength index, you understand the in volume analysis, you understand the balance volume analysis, you understand the key indicators, price actions, you understand trend lines, volume indicators, and so many other analysis like that. So this technical analysis tell you the prediction or the movement that the market is going to be in the next future. So when you understand this analysis, definitely you can take a very good position in the market. So lastly, what I want to show is the stop loss and a take profit. So when you have a stop loss and a take profit, what does it mean of stop loss and a take profit? That means you are stopping your loss. For the stop loss, that means you want to stop your loss. But for the take profit, that means you want to take a profit at a point that the market is, or that at the point that a particular commodity or particular security is in the market. So from my screen here, you can see this is Euro versus the USD. Now, the market is moving. The market is moving from this direction. The market is going upward, right? The market is going upward. So what do? Are you going to take your profits when it gets to this point, or you take your profit when it gets to this point, or take a profit when it gets to this point? Can you wait? How many minutes can you wait, or how many hours, or how many days can you wait? So this simply means that when you don't know, right? So that's why the market is always moving in different directions, right? So, but if the market is going upward, right, are you going to take your profits here, or take your profits here, or take your profit here, or take your profit here? What do? So taking your profit at an advantageous point is called the take profit position. But when you take your profit at a less advantageous point, means you are stopping your loss. All right. So stopping your loss means you don't want to lose everything in your required margin pocket or the required margin account. You don't want to lose all your money that you are using to trade. So when you buy when it's low, right, you sell when it's high. When it's high, and you buy when it's low. That's the key things in the market. So when you buy when it's low, you sell when it's high. So you take your profit when it is high. That means when you're taking your profit, that means you are selling. Remember, when you take your profit, you are selling, and someone else is buying as you're taking your profit, because when the market is going downward, it always is favorable for some traders. And when the market is going up, it's also favorable for some traders, because when it's going down, that's when you can buy. You buy low and sell high. So when it's going up, it's going high. So what the thing that you've bought when it's low, you're going to sell it when it's high because of the market movement or the sentiment or different news or different trends or different upcomings that is happening in the market. So taking profits is taking your profits as at the time you're meant to take your profit. Stopping your loss means you are edging yourself now, because you are speculating like, okay, I don't want this price to drop or fall below this point. If the price is fall below this point, that means I'm going to there is so much amount of loss. So you're going to stop your loss because you don't want to lose everything that you have in your margin pocket or in your margin account. So take note of all these necessary things I've explained. The next video I'm going to post, I'm going to be doing a clear scene of everything that I've explained. You're going to see it on a trading account. Like, you see everything I've explained. I'll show you everything that I've explained on the chart. Thank you so much for your time. My name is Bash on Air. See you next time.